Good afternoon, everyone. Thank you for joining the JKH Investor Relations Webinar for the third quarter of 2024-25. I am Gihan Kure, Deputy Chairperson and Group Finance Director, and I'm joined by Krishan Balendra, our Chairperson CEO, who will run the webinar with me today. The format of today's proceedings will be as usual, where Krishan will initially take us through a macroeconomic overview and some of the key highlights for the quarter. And then I will take you through a presentation of some of the key financial highlights for the quarter. And then we will open up for a question and answer session. If you have any questions, please enter it at the Q&A tab at the bottom of your screens. With that, I'd like to hand over proceedings to Krishan to take us through a macroeconomic overview.
Good afternoon, everyone. Thank you for joining our webinar. During the quarter, we had a parliamentary election in November, where the National People's Party won a very big victory, getting a large number of seats in parliament. With that election, which followed the presidential election, there is a stable government in place, and elections are not due for another 5 years at a national level. On the economy, the government announced finalization of the bond exchange, and with that, the country saw a credit rating upgrade, with the country being upgraded out of the default status it was in since mid-2022. Inflation continued to be low. In fact, we have now had a couple of months of deflation. So from the very high levels of inflation that we saw with the crisis in 2022, we have seen inflation coming down to very comfortable levels. The Sri Lankan rupee continued to be strong. From the lows of about 365 to 370 to the dollar, the rupee today is at about 298 to the dollar. Some other indicators also continued to be positive. The country saw a primary surplus, continued primary surplus in the latest numbers that have been released, and tax revenues overall have also been strong and broadly in line with what the government was targeting, or in fact better than what the government was targeting. After the end of the quarter in January, an electricity tariff reduction was announced, where tariffs have been reduced by an average of about 20%. On some of our sectors, the tourism arrivals continued to be very encouraging. Month of January, just concluded month of January, we saw arrivals of 253,000, and that was the highest ever number for the month of January. This increasing tourism arrivals was reflected in the performance of our hotels, which continued to see improving occupancies. Bookings for the next couple of months, for the rest of the season, are also looking strong, and we expect that just based on the performance in January, that 2025 should see the highest number of tourist arrivals ever in Sri Lanka, and that we are back on that growth trajectory that we were on prior to COVID, where with the end of the war in 2009, the country saw double-digit growth in tourist arrivals annually. Consumption also continued to pick up, and we'll discuss in detail when we get into the performance of our soft drinks, ice cream, processed meats, and our supermarkets businesses. The Cinnamon Life project, as you know, the Cinnamon Life Hotel is now fully operational. All the ballrooms are operational and the restaurants are operational. fit out for the casino is progressing very well, and we are on track to see the casino commencing operations in the third quarter of this calendar year. The mall is also expected to commence operations around the same time as the commencement of the operations of the casino. The West Container Terminal work has progressed on schedule, and we expect that the first vessel will call at the West Terminal in this quarter, in fact, most likely by the end of February. And phase 2, completion of phase 2, a full completion of the terminal will be about 18 months after that, in the second half of calendar year 2026. So that was a quick update on the macroeconomy and some of our key projects. I will hand over now to Gihan to run through the detail on our quarterly results.
Thank you, Krishan. So I'll take you through the key financial highlights. Just to remind you once again, if you have any questions, please enter it into the Q&A tabs at the bottom of your screen. If you look at the performance starting with the group EBITDA, at a headline EBITDA level, we grew 4% in the quarter to 14.3 billion rupees. But I'll just take you through some adjustments that we've made just so that you could understand the core recurring performance during the quarter. So this quarter we had a fair value gain on investment property in our property business of around 950 million rupees. Typically, these adjustments of our fair value gains and the valuation of these have taken place in Q4, but to streamline our accounting practices and processes, we've actually decided to make those changes in Q3, and that will be a one-time change, and going forward we will continue to recognize such changes in Q3. So this year you will see that distortion where this time we are having the gain in Q3, whereas you will also find some adjustment in last year's number for Q4. We also had a deferred tax credit at SAGT of around 400 million in the previous financial year, whereas this year we don't have anything in this quarter. And of course, the large item is the other operating costs at Cinema and Life City of Dreams, where we have a EBITDA impact of around 1.5 billion for the quarter. We've just started operations in that quarter, so we started operations on the 15th of October. So effectively this will ease the sort of running cost that we will be having at the Cinema and Life City of Dreams, whereas last year it was more the pre-opening costs of around 240 million. So when you adjust for those three main items, we end up with an EBITDA of about 14.9, which is a growth of 10% over the last year. If you look at the composition of EBITDA in terms of the main businesses, right at the bottom of the screen you see the same two numbers I spoke of the 4% and 10% growth. But if you look at the businesses, and I'll take you through each of the different businesses, but we've seen strong growth as we have seen that momentum continuing through Q1, 2 as well, with consumer foods, retail and financial services all recording a strong performance. In the transportation business, we did see a negative impact. Leaving aside the deferred tax credit at SAGT, we did see an impact in our bunkering business, which I'll talk you through. And at leisure, of course, it's mainly the Cinema and Life City of Dreams impact, which again I will walk you through when we get to those slides. If you look at the cumulative performance for the 9 months, of course, it's a translation of the performance for Q3 as well as the first half of the year. I won't go through each of the numbers, but essentially again you see a similar adjustment that we've done to the 9-month EBITDA versus the other adjustments, which will give you 6% growth in the cumulative performance if you look at it more on a like with like basis. Just looking at the quarterly EBITDA movement, as you can see the headline numbers, of course, with a 14.3 billion for Q3, But if you just adjust and eliminate the impact of the operating cost of City of Dreams, we are looking at about a 15.8 billion. So if you look at it on a quarterly basis, you can see it's quite a significant increase even against Q3, whereas Q4 tends to be our peak. So this number is quite a strong number when you adjust for the impact of the opening of City of Dreams. Just looking at the finance costs, again, I'll just take a minute to explain this, because if you look at the finance costs in all our businesses, the numbers have actually come down from what we seen before. So if you look at it reading from right to left, with the leftmost column being the most recent, you've seen the numbers coming down in our consumer foods, retail businesses, as we've seen the interest costs coming down, which is right at the bottom of your screen, from about 13% last year to 9% this year. And also the working capital requirements and so on reducing. The main impacts, of course, here is what we have at, again, leisure, where there are rather the $200 million of the loan at City of Dreams or Cinnamon Life. And of course, we have the exchange movement, which is the unusual one here, because when we see appreciation of the rupee, as we saw in the last quarter, then you do have a financial sort of exchange gain, which is why you see that distortion from quarter to quarter, which is what we've tried to sort of explain away here and show a more normalized impact. The other aspect I wanted to just touch on here is the non-cash interest charge we had on the convertible debenture, and I'll explain to you. We did announce that the debentures were exercised and now fully converted, but we had a non-cash charge of around 480 million in Q3. In Q4, because the debentures were converted in mid-January or late January, around the 24th, we will have some impact, but nowhere near the 480 million. And going forward, then this charge will not be there at all. So like I said, in Q4, we'll just have the charge for about 3 weeks of January. If you look at the PBT again, similar flow-through impacts from EBITDA that we saw. I already spoke of some of the other adjustments that we did in terms of the gains on investment property, as well as the deferred tax credit at SAGT. The other one which we've shown is the PBT impact of City of Dreams Sri Lanka. So if you recall, I spoke earlier of the impact at an EBITDA level of about 1.5 billion, which is the operating costs or net impact of the City of Dreams. So as we've said in our disclosure as well in the chairperson's message, the ramp up of operations is taking place. Naturally, as expected, it is a little slow because it does take time. So that is the net impact that you're seeing at EBITDA level. But at a PBT level, we also have the impact of the depreciation charge coming in, as well as the interest cost, which was earlier capitalized into the project cost. Now both these are actually impacting the P&L. So as we've disclosed, that amount is about another 2 billion rupees. So if you look at the combined impact of the City of Dreams, is about a 3.6 billion. We did have a forex gain on the loan translation, as I mentioned before. That's at around 818 million. So if you net off all that and look at what our PBT on a more adjusted basis, we are at about 7.9 billion versus the 6 billion last year, which is around a 30% growth on an adjusted basis, whereas at a headline reported level, we've shown about a 11% growth in our PBT. I already just touched on this as we announced on the 24th of January. HWIC Asia Fund of Fairfax announced converted the balance remaining debentures and fully exercised the debentures that they have. And with this, there are no further convertible debentures that we have. So the dilution from this is about 6%, and with that, HWIC has a total shareholding of around 24% in the company. Looking at some of the key balance sheet indicators, we've seen our debt levels at a gross group debt level coming down from 230 billion, coming down to 210 billion. And just to remind you that we had the proceeds from the rights issue of roughly 24 billion coming in, but that came in post the closure of the last quarter because it came in around mid-October. So that's why you see this reduction from 230 billion to 210, and a similar sort of reduction in terms of the net debt of the group. So now with the proceeds that we have and the total debt levels, our net debt to equity has reduced from about 36% to around 27%. In terms of some of our ESG reporting, we've seen an increase in our absolute numbers on our carbon footprint as well as water withdrawal. And the primary reason for that is that with the commencement of operations at Cinnamon Life, we've seen that increase because last year we didn't have operations, and therefore the electricity consumption as well as water usage is the main reason for this increase, because the rest of the businesses, actually ex of Life, we've seen things being quite flat. Moving on to the businesses and the update, just looking at the transportation business. If you look at overall volumes, we saw very strong growth in volumes at SAGT from last year's around 428,000 TEU. We've seen a significant increase to 535,000 TEU. And if you look at it even over Q1 and Q2, this is quite a significant achievement, and sort of really does push the business to operating at very much close to capacity. If you look at it in terms of the mix, it's sort of in line with what we saw, marginally lower than Q2, but the main increase, of course, from 512,000 TEU to 535,000 TEU coming from transshipment. But if you look at it over last year, we've seen a slight improvement with a little more domestic volumes. And overall, this volume growth resulted in SAGT having a very strong performance for the quarter. Unfortunately, the bunkering business, whilst we did see volumes grow at quite a healthy 20% growth in volume, we saw margins erode, partly due to or largely due to more intensified competition in the local bunkering market, as well as a slight oversupply situation in the market, in addition to some declines at points of time during the quarter in base oil prices, which also resulted in a contraction of margins. So as a result of that, we did see the bunkering business having a slightly negative quarter, which did erode the performance of the overall transportation business. But in terms of outlook, we expect that to sort of normalize, and the bunkering business right now is seeing better momentum in terms of performance in this quarter. Krishan already spoke on the progress on WCT, so I won't get into the details of that, but the image you see on the screen, the cranes have been installed, and now we are about to receive our first the test vessel in a couple of weeks' time. Our consumer foods business saw very strong momentum, as you can see, continuing from the sort of momentum we saw in Q1 and 2 as well, with ice creams growing at 34% and soft drinks, carbonated soft drinks growing at 28%, and our convenience foods business also saw strong volume growth at 24%. Just to remind you, and when we go through the next couple of slides, you'll see that Q3, whilst this is strong growth against last quarter, Q3 is a slightly, in terms of overall volumes, is a slightly lower quarter than Q2, and then Q4 tends to be the peak. So as a result of that, when you look at the margins, you don't have the full benefit. When you look at it on a quarter-to-quarter basis, our margins have declined from 17% to 15%. But if you look at it on a year-on-year basis, our margins have increased from 13% to 15%. The other aspect of it is, if you look at our ice creams business, you can see again, when you look at the quarter-to-quarter number, you see that last quarter we had a bulk to impulse ratio of about 62 to 38, whereas this time we see more bulk sales, so the ratio is skewed a little bit more in favor of bulk. And as you all know, the margins between bulk and impulse is such that impulse has a higher margin, so a higher contribution from bulk does result in a lower percentage margin. But as you can see, in terms of absolute profits, it's a very strong growth with a 1.3 billion of EBITDA versus a 900 million in Q3 last year. So very strong momentum that we are seeing in the business, and we expect that momentum to continue. And as I said, if you look at the quarter-to-quarter basis, typically you've seen this where even in the previous years, if you look at it, Q3 tends to be a lower quarter, and that's the same sort of trend you're seeing. This is of course indexed, but if you look at it in soft drinks, you're seeing that over the years right across, you've seen Q3 being low. But when you look at Q4, as you can see, Q4 tends to be always a better quarter, and that's the trend we expect to see, and that margin recovery will happen Q to Q as well. And similar sort of trend in ice creams, maybe less so than beverages, but again a similar trend where you see again Q3 tends to be lower in terms of absolute volumes, and then you see a pickup in Q4. Moving on to our retail business, our supermarkets business saw again very strong same-store sales growth of around 14%, mainly driven by footfall growth again of 14%. Similar to what we've seen, if you look at right across the screen, across the 5 quarters, a very strong, healthy growth in footfall. We've seen basket values being flat, whereas last quarter we saw slight growth, but I'll talk you through that when we get into the decomposition of same-store sales. Very strong revenue growth overall, top line growth, driven of course by same-store sales and footfall. And again, a very strong EBITDA growth. And if you look at EBITDA margins for the quarter at 8.1 versus a growth from 6.9%. So strong growth in overall margins. And if you look at it versus Q2 to Q3 as well, we've seen that growth. We've of course had the benefit of the reduction in electricity tariffs as well, which Krishan referred to as well. And that translation of the benefit of that also has certainly helped margins. But some of the other initiatives has also helped along with the sort of growth in absolute volumes. If you look at it, I won't spend too much time on this, but we've looked at the total margins here. And if you look at part of it, like I said, is due to the electricity impact. So if you look at the percentage cost of electricity cost versus revenue, you've seen that decline. But if you look at the margin improvement, is much greater than just the benefit of the electricity cost. Looking at the decomposition of the growth in same-store sales, as I mentioned, it's driven by footfall of 14%. ABV was flat, but what's sort of encouraging in a sense is that ABV was flat despite inflation actually being recorded at a negative 2%. So the weight of purchase, as we call it, or the number of units that are in a basket actually increased to offset this decline of 2% in inflation, which is why ABV itself was flat. So that again demonstrates the type of recovery in consumer spend or sentiment, because now you're seeing that recovery in the number of units that consumers are buying into a basket as well. Staying with the retail business and moving on to our new energy vehicle business vertical. The market opened up as was expected, but the government most recently announced the opening of the market on the 1st of February 2025 with the Gazette and also the final duty structures and so on. We've had a very strong, healthy pipeline of vehicles, and now we are in the process of processing the orders and opening the letters of credit. The teams are looking at the sort of pricing impacts and how we manage that based on the revised duty structures, and engaging with customers to then start commencing the importation and then distribution of vehicles, which will start towards the end of this quarter onwards. We've already rolled out some of the charging stations within our supermarket network, and we've got about 10 outlets installed to date, with more in the pipeline. Moving on to our leisure business, as Krishan said, we saw a peak in the month of January, which is the highest we've seen ever for the month of January, slightly lower than the peak that we saw in December 2018 of 250,000, but very healthy recovery. And if this trend continues, from what we saw even in December, almost 250,000, which is pretty much in line or even now getting to the territory of being better than the pre-Easter, pre-pandemic levels. And Krishan already spoke of the sort of forward bookings and the visibility that we have. So it's very encouraging to see what's happening on the ground with leisure in Sri Lanka. In the Maldives as well, the numbers have been quite strong anyway over the last couple of quarters, and that trend has continued with growth over last year in terms of arrivals. I will skip this slide. We've spoken of the India opportunity, and I think how Sri Lanka can take advantage of that in terms of tourism, inbound tourism into Sri Lanka from India. So looking at the numbers in leisure in Colombo, in the hotels, these are the two main Colombo hotels, that's Cinnamon Grand and Cinnamon Lakeside, where we saw occupancy growth with the type of number of arrivals into the city, but it did come at the cost of a slightly lower ARR, because whilst we have seen the growth in overall numbers, we've seen an increase in the inventory as well in the city, with not just the Cinnamon Life Hotel with 687 keys, but a few other properties coming on stream as well. So as a result of that, I think there was a little bit more competition, and whilst the overall numbers have grown, I think as we've mentioned before, the key catalyst for the city will be Cinnamon Life or City of Dreams starting the gaming operations, as well as some of the traction we are seeing in terms of inquiries and leads at Cinnamon Life converting to actual sales and occupancy in terms of MICE events. And I'll talk to you a little bit later about that. So as a result of that, we did see a slight decline in our EBITDA margins in Colombo hotels. With Sri Lankan resorts, we saw occupancy in Q3 increasing slightly against last year, but the ARR with a very strong increase. And as a result of that, EBITDA margins jumping from 15% to 23%. As you all know, Q4 is the strongest quarter for leisure. So the Sri Lanka resorts performance in Q4 is expected to be better than this, and see that momentum continuing with the tourist arrivals, and even Colombo hotels should see a rebound, but particularly in Sri Lankan resorts, we would expect to see the numbers improving on Q3. With Maldives as well, again, Q4 will be the peak season. Against last year, we've seen occupancy and ARRs being more or less in line, with a slight improvement in our EBITDA margins. Overall, if you look at our leisure performance, we've seen ex of Cinnamon Life a slight decline, and the decline is stemming mainly from the fact that the Maldivian resorts did see a decline due to the translation impact as a result of the stronger rupee, where the rupee appreciated around 10% over last year. On a dollar-to-dollar basis, the Maldivian resorts actually performed slightly better. So the decline is just in terms of the translation in rupee terms. Colombo hotels did see a decline due to the reasons I mentioned, and the Sri Lankan resorts did see an uplift or uptick in terms of its performance, though it wasn't enough to offset the declines as I mentioned. But the Q4 outlook is looking quite positive. With City of Dreams Sri Lanka, Krishan also mentioned we've seen a very good positive feedback from customers who've patronized the hotel and the different food and beverage outlets. We've seen good traction in terms of events and conferences, mainly locally. As we've said before, there's always a lag effect in terms of winning international conferences and international weddings. We have quite a strong, or not an order book, but leads that we are working on. But we expect to see some of those materialize maybe over the next couple of quarters. So the occupancy itself at City of Dreams or Cinnamon Life has been quite low in the quarter, where initially we've seen 30, 40, 50 rooms being occupied, and then that's been slowly ramping up. The outlook for February, the month of February, is looking much better, where occupancy should be close to 20%. And as we ramp up, we hope to see these numbers getting better. So like I said, as we convert some of the leads that we have for corporate events from overseas, because really we're looking at creating new demand. And whilst we have got a fair number of bookings of local events, I think the needle will really move in terms of getting overseas demand coming in. The other key aspect, of course, will be the commencement of gaming operations, and we are very much on track for opening around mid-August, September with the gaming operations. The other aspect I'd just like to touch on, which I already mentioned, is the impact on the financials of City of Dreams. And as we've mentioned here on the slide, there's a depreciation and interest expense of around 2 billion rupees that we had recognized in the P&L during the quarter. The depreciation charge will ramp up a little further because this is based on the depreciation of the elements that we have opened. And whilst the large part of the totality of the integrated complex is open, we do still have some other elements to open, like the 113 rooms of the Nua Hotel and so on. So this depreciation charge will increase a little further once we get to full operations. But on the other side, and on a more positive note, we will see the ramp up of revenue as well as rental income kicking in as well. Just some images on City of Dreams, Sri Lanka. On the property business, we've seen good traction on the sales of apartments and the leads that we've had. This quarter, we saw some sales actually happening with Cinema and Life at the apartments, and with Trizen as well, as we've completed the project, and with Viman. So all our three developments have seen a reasonable amount of sales. Of course, we did have the elections in the parliamentary elections in November, and then heading into December, sometimes some of the conversions may take a little time, but we are confident that we will see this momentum continue, where particularly with Trizen and Viman, we've seen good interest with the completion of Trizen in particular. With Cinema and Life, we've actually prioritized collections a little bit. So we've been offering attractive rates just to ensure that we do have sales coming in and we get cash collections into the project. So as we continue over the next couple of quarters, we will continue to do so. And then depending on how the sales momentum is on the remaining 148 units, we will look at how we look at our pricing from that point onwards. Lastly, on financial services, a very strong quarter that we had, particularly in the bank. So I'll talk to you first about that. So over last year, we had a strong growth in performance driven by loan growth. NIMs were slightly down, naturally, with the interest rate environment that we've seen. But overall, loan growth has been positive, so that's contributed. Impairment also has been less, with stage 3, net stage 3 loans being at 1.8% compared with 3.3% last year. So that also did help. And we did have net gain on the disposal of the sovereign bonds that NTB held. As we've said before, NTB didn't hold a significant portion of ISBs of the government, but still, based on what they held, we did have a net gain, so that also did help. In the insurance business, we saw again strong double-digit growth in GWPs, and that did help to a strong profit as well. So overall, that's been the performance for the quarter. I'd like to end the presentation now and open up for the Q&A session. Once again, just to remind you, you may enter any questions that you have on the Q&A tab at the bottom of your screen. Krishan, I think we already did touch on this, but there's a question on the status of City of Dreams and the casino, and whether there are any changes to our plans from what we had outlined before.
No, there is no change. As I said earlier, the fit-out is on track. The fit-out is being done by Melco, who are investing over $125 million in fitting out and equipping the casino space. and there is no change from what we had indicated earlier, and we are looking at commencement of operations in the third quarter of the current calendar year.
Krishan, can we get a sense of what levels of occupancy and room rate that Cinnamon Life could be expected to break even? Of course, there are other elements of revenue and profit in the complex, so it's not a straightforward answer in terms of the hotel itself, but any indication that we can...
Yeah, unlike a typical hotel where you would have the rooms and the F&B revenue, and in the city you have the material banqueting revenue. In this case, in full operations, the hotel includes a significant retail space, and of course it also includes the casino. So that distorts or changes the break-even number that you normally see, which in a typical hotel might be an occupancy of about 40% at ARRs of $100 or so. So in this case, I don't want to give a figure because there will be so many moving parts, but the required occupancy and the room rate for break even would be less because of the other components of the hotel.
Thanks, Krishan. There's also a question on the sort of consolidated impact of the City of Dreams results in the financials. I think we did speak fairly extensively on this, whilst the question also does ask about sort of the EBITDA margins, I think at this stage, because you're just ramping up a new property. So the EBITDA margins, as we said, we did have a EBITDA bleed with the costs coming in and a slower ramp up of the hotel operations. So the 1.5 billion is the EBITDA negative number that we spoke of. So like I said, the margins itself wouldn't really make any sense. And as we said, the ARRs and occupancy numbers are quite low. But I think we've given enough color in terms of the overall numbers and the run rate of costs that we are seeing. But then it's a question of how quickly we expect occupancy to pick up. And like I did speak of just earlier, it is really the catalyst being getting gaming numbers coming in, as well as, of course, the conferencing numbers coming in as well. Krishan, any challenges we anticipate on the leisure portfolio due to the Maldivian crisis in terms of their financial as well as political issues that they're facing?
Yes, I think the macroeconomic situation is quite fragile, a little like what we saw in the run-up in 2022. And while we can't say with any certainty if the macro situation continues to deteriorate, there is the risk of the possibility of higher taxes. But the one difference between the Maldives and Sri Lanka is that it is anyway a dollar economy, the Maldives. So the impacts of steep depreciations, we don't expect to see like what we saw with the crisis in Sri Lanka. But there is some uncertainty around the macro. It is very fragile, and there is the possibility of impacts like higher taxes.
Krishan, any guidance we can give on the outlook for Q4 ARRs and occupancy for the Sri Lankan resorts?
Yeah, we don't typically give a guidance, but as I said, bookings are very strong. We've had a very good January, and overall RevPAR or revenue per available room for our Sri Lankan resorts, we expect will be higher than last year. That is January, February and March 2024. And in fact, we think based on bookings at hand that the RevPAR for the quarter will probably be the highest that we have seen ever.
There's a question on the CSD volume increase, whether it consists of exports into the Indian market. So as we've said before, though, our exports is actually the concentrate that we export under the franchise arrangement. So we don't have volumes that we count as whatever that's manufactured there. It's really only the concentrate that we export. So the volume growth that we refer to is really actual volume growth that we're seeing in the market here. And that momentum is something we would expect to see continuing. So the export volumes, like I mentioned, do not get captured into the Indian market. Of course, we do have some other export volumes into different markets where we have actual, not just the concentrate, the actual product being exported, but those are very small or negligible in the context of the numbers we are talking about. There's also a question, or part comment and question about the frozen confectionery or ice creams and soft drink volume showing encouraging growth despite the adverse weather impact in Q3. And do we see the same momentum in the running quarter as well? So as the comment has mentioned, yes, there was excessive rains, particularly in the first part of the quarter in Q3. But despite that, we saw volume growth vis-a-vis last year. Had it not been for that, yes, we could have possibly done a little bit more. Q4 generally doesn't tend to have that type of weather disruption typically, and we are not seeing that type of impact right now. So the momentum that we are seeing certainly should continue. There's a question on, maybe I'll just move to retail, on how many stores we expect to open in the next year. So we've looked to add maybe about 10 to 15 outlets in the next year. This year we will end up with around 7 to 8 by March, new stores, and next year we will look to ramp that up a little further. There's also a question on the cost efficiency improvements done in the retail sector and the net impact to margins. So I think I already spoke of the impact to EBITDA margins and what we've seen as an improvement. Part of that, but obviously not a majority of it, part of it is driven by the benefit we are seeing on the electricity tariffs. But there are other productivity improvement initiatives that we have done. And of course, when you see that sort of healthy top line growth, activity growth that we've seen, that also does tend to then help dilute your other fixed cost base, the distribution center costs and so on, which then does have a flow through effect, which does help improve margins as well. So it's a combination of a couple of things that we've done that has enabled us to improve margins, and that momentum again hopefully should continue. Krishan, any comments on the changes to the competitive dynamics in the bunkering business and the impact to LMS market shares, if any?
LMS has managed to retain its market share, in fact, increase its market share marginally. So there hasn't been any impact in terms of market share. There has been increased competition with new players in the market, which has had an impact on pricing. And there have also been volatility in exchange rates and in the oil prices over the last few months, which has also impacted the margins of the business. But in terms of market share, we have retained or slightly improved our market share despite the increased number of players in the market.
Thanks, Krishan. A couple of questions on leisure again. Maybe I'll take the last one and I'll hand over the others to Krishan. There's a jump in capex at AHPL this quarter. Is that for refurbishment? So I think last time we spoke of some right sizing that we were doing in the property, and part of that was also shutting down some restaurants. We relocated some restaurants as well. We moved Cheers from one location to the other. So there was some capex that we incurred but that right sizing also was going to help us in terms of our overall operating costs and ultimately our profitability. We've answered this question before, but there's a question on the future of AHPL and Tran, given that Cinnamon Life is operational. As well as Krishan, maybe I'll also ask you this question in terms of the tourism mix of Sri Lanka and the Maldives segment in terms of source markets.
Yeah, taking the second question first, the mix, there is a change. If you look at in the Maldives, China has recovered. China was by far the largest market into the Maldives prior to COVID. The change we have seen in the mix while China has recovered is that the Indian numbers have also grown significantly into the Maldives compared to five years back. Although in the more recent past, like a year back, because of some of the geopolitical tensions, the Indian numbers dipped. In Sri Lanka, the change in mix is that prior to COVID, China was the second largest source market into Sri Lanka, behind India. And today, Russia in the season has been the second largest source market, with China being something like number 5. The Chinese arrivals numbers are getting better, but still well below the numbers that we saw in calendar year 2018, where it was the second largest source market. So those are the material shifts we've seen in mix in Sri Lanka and India. On the question on HPL, now our view, yes, Cinnamon Life is operational, and the Nua Hotel will be operational from around the time the casino opens, which will be in the third quarter of this calendar year. But our view is, given the proposition of Cinnamon Life and the City of Dreams, Sri Lanka, we expect that arrivals to the country and occupancy in the city will increase considerably, given what we are adding to the city with the property, and with that occupancy and rates at Cinnamon Grand and Cinnamon Lakeside should also increase. So we see those two properties benefiting from City of Dreams when it is in full operation. And at the right time, we may even look at refurbishing one or both of the properties. But also we have said that our exposure to the hotel segment overall, not just the city properties, but including the resorts and including the Maldives, is now a little distorted with Cinnamon Life in terms of our overall portfolio. And in terms of balancing our portfolio, we may look at diluting our exposure to the hotel segment. But that is not something that is linked to the opening of Cinnamon Life and any impacts that could have on Cinnamon Grand and Cinnamon Lakeside. In fact, with what Cinnamon Life is bringing to the city, we are positive on the outlook for the city hotels.
Thanks, Rishant. There's a question on the economics of the relationship with Melco, or really the gaming facility. I think what we've said before is, if you look at the casino rental, we've structured it as a sort of landlord-tenant relationship, and essentially we will have a fixed and variable rental stemming from the economics of the gaming operations. And as we've outlined before, and this is just to illustrate a number, but I'll get into that. But essentially what we stand to get is a fixed rental and a variable rent that's linked to the EBITDA of the gaming operations or the gaming company, which will be run by Melco. So approximately 50% of the EBITDA would be something we stand to benefit from. And the total rental range that we would expect is around 50 to 55% of the total economics of the gaming venture. So just to illustrate this, if you're looking at a $250 million of GGR, or gross gaming revenue, at a 40% EBITDA margin, what we've said is the EBITDA could be, again, this is not guidance, but $100 million, and we would get around $50 to $55 million as as a possible rental. So that's really how the rental share would come from us. Yes, there are other components of things like hotel management fees on NUA and branding fees, but in the context of the numbers, those are not very material, and we stand to benefit from other aspects of the relationship as well. Just moving on to a couple of questions, Krishan, on BYD. With the opening up of the market and the revisions or updates to the duty and tariff structures, there are a couple of questions on whether we are seeing any impact on the orders as well as how we are dealing with that. And there's also a question of whether how the profit share would be recognized. So I think maybe if I just take that one, we would be, I mean, it's a normal distributor relationship where we will be importing and recognizing a profit on each vehicle and sales of that, and we'll be recognizing that. But maybe, Krishan, if I ask you to respond to the question on orders.
Yeah, it's a little early to comment on the impact on orders. We are now engaging with our principal in the context of the new duties and taxes to finalize the pricing. It looks as if there will be an impact, but we are working with the principal to minimize that impact compared to the prices we showed at the time we took the reservations. So we have not gone back to our customers with a final price. So it's too early to comment on the impact on orders, but we are working with the principal to minimize that impact.
There's a question on the update on the funding for the West Terminal project. And as we have said, the funding has been always in place, and the funding from Adani, because the financial closure for this project was on the basis of the funding from the Adani group being there. So based on their internal capital management plan, and we will be able to fund the project. We will be starting operations, as we said, so phase 1 itself will commence in a couple of weeks' time. Of course, phase 2 will require further funding, and that commitment is very much in place from the Adani group. There's also a question on the current port congestion and the impact on SAGT and the WCT. I think here, as you saw with the volumes that we've seen, despite some of the congestion issues, the demand for Colombo and transshipment in Colombo has been very strong. The congestion issues are being resolved gradually. So really, it's more a question of with WCT coming on stream and having more much needed deep water capacity in the port of Colombo, the opportunity is there for Colombo to really grow volumes further. And of course, if we don't have the issues of congestion, I think it'll only help to do that much better. But I think despite that, we will still see strong growth, particularly once more new deep water capacity comes into or comes on stream. There's a question on the split of the 2 billion impact I referred to earlier at the Cinnamon Life City of Dreams in terms of depreciation and interest cost. So if you look at that number, roughly it would be about half, maybe 55-45 depreciation to interest. But like I said earlier, the full depreciation impact has not come in. Most of it is there, but there's still a little bit more as we bring in other elements like the 113 keys of NOAA. It's also important to remember that the rupee interest cost, of course, because this is a dollar interest loan that we are servicing, the translation of that will depend on the exchange rate. So that number can move a little bit up and down depending on where the exchange rate actually is. There's a question on the debt that we carry at Trizen. So we don't consolidate Trizen, and therefore the debt of Trizen is not consolidated in our books. But yes, the Trizen project does still have some debt. And so when we clear or collect funds from customers as we sort of continue to hand over the remaining units that we've sold, then that net number will come off. But at an operational level, yes, the Trizen project company will make profits, and particularly in Q4 and heading into next year, we will make profits because the debt levels have come down and will get eliminated very soon once we hand over the rest of the apartments as well. And the rest of the remaining units then will be a direct flow through to translation of profits. I think I already covered this, but maybe just for clarity, I'll repeat it. The question is on the debenture conversion and the impact on financials. So as we've said before, and as I highlighted through the presentation, we had an impact of around 480 million rupees in Q3, which is the non-cash, the notional impact that we had on the debenture. And that amount will fall away fully. You won't see the full impact going away because as I mentioned earlier, the debenture was converted on the 24th of January. So you will have that component stay on for that period. But if you look at a quarter without the debenture, that 480 will fall away fully. And of course, we had a more nominal 3% cash interest charge. So that amount also will fall away. So roughly 500 million plus will be what goes off as a result of the conversion. Again, for clarity, just a question on whether Trizen is fully completed. Yes, the project is completed. Handovers are happening gradually given the quantum or volume of apartments to be handed over. All revenue is not recognized because we have a revenue recognition when we hand over units, and of course there's a remainder of units to be sold as well. There's a question on the JKH, the capex focus in the medium to long term. As we've said before, we were in a very heavy capex cycle over the last couple of years, and our main large commitments that were remaining was the completion of Cinnamon Life and the City of Dreams integrated resort, and most of that is now done. Yes, we've got another maybe $75 million or more to go to fund the rest of the project in terms of the financial servicing obligations and so on. And with the West Container Terminal, again, our equity contributions, around 75% of our equity contribution has already gone in. We have around another $20 million only to go into the project. The rest of the capex that we're really looking at, you won't have anything as significant. Of course, each of the businesses will have their capex plans, like with the supermarkets adding outlets and so on. But in the context of the capex that we've seen over the last couple of years, that those capex items will be very well and easily managed within the cash flow generation of each of those businesses. So yes, we will have supermarkets adding outlets. Yes, we'll have some capacity expansion with the type of volume growth that we're seeing in the consumer foods business, with investments in ice cream capability, as well as some expansion of capacity that might be needed in the next year or two in soft drinks. But all that will be, like I said, very well managed within the business and the cash flow generation. Krishant, there's a question on any changes from the new government that we're expecting and how it may affect JKH and or its other listed subsidiaries.
No, there is nothing specific that we are expecting, and we've seen with the elections in September and then in the parliamentary election in November, the economic policies in terms of working with the IMF and some of the other reforms that were undertaken after the crisis, we have seen continuity, and there has been no policy change that has had a material impact on any of our businesses, and there is nothing specific that we are expecting going forward either.
Thanks. Sort of coming to a close, I think there are a few more questions to deal with, so I'm just going to pick one or two questions in the interest of time, and apologies if we couldn't cover everything that was posed, but we tried to cover some of the key impacts. I think there were a couple of questions on the impact of the exports to India through the Reliance partnership. That's not very material at this stage. It's just ramping up. So the volumes that they're seeing is very encouraging, but in terms of bottom line contribution to us and the performance that we are seeing, it's not really material. There's also a question in terms of the new outlets and existing outlets, what the proportionate contribution that we are seeing. And really when we look at same-store sales and the growth, a lot of it is coming through the existing outlets, because anyway, in the last year, we really haven't added too many new outlets. I think we're out of time, so apologies once again. I think I've covered most of the question, but there are a few questions remaining. Thank you very much for joining and participating in today's webinar. This will be posted up on our website in a couple of hours for those who wish to watch the recording or who may have missed part of it. Thank you once again for joining us today.
Thank you.